If you owned a home in Toronto over the past 2 years, you would have done very well. On average, detached properties in the 416 area went up 40%. So on a $1.5 million home, that's a $600,000 bump in equity. Of course, you can keep the money in the house and you would still continue to make money as your home price continues to go up. But if you wanted to make better use of that equity, there are ways where you can pull it out, reinvest it, and help your wealth grow even faster. If you're new to this and want to learn how this is done, then keep watching. In this video, I'll be walking through 3 ways to refinance and access the equity in your existing home, specifically related to real estate investing. Before I start, don't forget to give this video a thumbs up and subscribe to our channel so you can see more videos like this made specifically for real estate investors in Toronto. With a typical home mortgage, a portion of your monthly payments go towards paying down your principal and a portion goes towards your interest. So what this means is that the equity that you own on your home will start to go up and the debt portion of your home will start to go down. On top of this, real estate increases over time, so that also further bumps up the equity portion of your home. Now, most lenders allow you to borrow up to 80% of your property's market value as long as you qualify. So if you currently have less than 80% of your property's value borrowed, then you can refinance your property to access it and reinvest the equity. The big question is refinancing to reinvest actually a good idea? Yes, it is. The money sitting in your home is your gain. So technically, you can sell your home and then reinvest it into a bigger home with the extra gains that you have. But the benefit of refinancing is that you don't need to sell your home if you don't want to, and you can collect rental income on that money and defer the selling fees and taxes until a later date. Because we can avoid things like possible capital gains tax and other fees, you end up getting a bigger chunk of money to reinvest, which means better total returns for you. Here's another thing. Normally, the interest on your principal residence is not tax deductible. However, when you refinance a portion of your principal residence for the purpose of investing, the interest on the refi might now become tax deductible, which is another big benefit. Just know that if you want to do this, you need to make sure you do it correctly. So definitely seek advice from a professional accountant if you want to employ the strategy. Refinancing is a good idea and it works especially well for real estate because it's very possible to buy a second property with no money out of pocket. The down payment and closing costs can come from refinanced funds, and then you can get a new second mortgage to cover the rest of the purchase price of the new property as long as you can qualify for another mortgage. So with a $1.2 million house in Toronto today, you can actually buy it with all borrowed money and you're still going to be cash flowing close to break even, and you continue to gain rental income and appreciation on that property. So if you're ready to get started with refinancing to grow your real estate portfolio, let's learn 3 main ways that you can get this done. The first way is to cash out refinance by breaking your old mortgage and replacing it with a new one. The difference between the 2 mortgage amounts minus the bank fees and penalties will be paid to you in cash, which you can use to reinvest. This method is very popular with real estate investors who are growing at a very fast clip, and most of these investors tend to be on variable mortgages. Let's take a look to see how this exactly works. When you break a mortgage with a variable rate, the penalty would be equal to 3 months interest. So assuming that you're on a 1.7% variable rate, that penalty would equal 0.425% of your loan amount. On a $1 million loan, that's $4,250 in penalties. The big benefit is that after you do the refi, you might be able to access enough equity to get into the next investment purchase with the perks of rental income and appreciation that I just talked about, which can be huge. It gets even better if you're able to refinance and get a better discount post-refinancing. Say you manage to secure a 1.6% variable rate on the refi, so you end up saving 0.1% of your loan amount per year. Over 5 years, that's 0.5% in savings, which more than makes up for the penalty. So is there a time when cash out refinancing not makes sense? I'd say it's not as good of an idea for fixed rate mortgages, And investors really felt that in the past couple of years when rates dropped a lot. When you're on a fixed rate mortgage, the penalty for breaking a mortgage ends up being the higher of 3 months interest or a calculation based on interest rate differentials. Essentially, banks don't want to lose out, so the penalty you'd have to pay would equal your savings if you break a fixed rate mortgage to get a new one. In other words, refinancing a fixed rate mortgage to get a lower rate usually does not make sense. Instead of having to pay for the difference in interest rate over the rest of your term, you end up having to pay for everything upfront as a penalty. Your cash out refinance amount at the end of the day gets reduced drastically by tens of thousands of dollars in many cases, and you'll have less money to invest with, less absolute returns, and in the Toronto real estate investing world, it can likely mean the difference between investing in a freehold with better returns and a condo with lower returns. Another popular way to access the equity in your home is through a home equity line of credit or a HELOC. The advantage here is that once you have a HELOC set up, you can borrow money up to your limit without having to go through the process of breaking existing loans, paying penalties, or entering new loans. The downsides is that HELOC rates tend to be higher and you can't get a fixed rate if that's something important to you. So most investors tend to use HELOCs for shorter term loans like renovations. Let's say you want to upgrade your existing home and put in $100,000 in renovations. After renovations, your home price might go up by $200,000, so you do a cash out refinance on the property post renovations to pull out the extra equity and get the best borrowing rates. But let's talk about renovation money. If you need to borrow $100,000 for half a year, how should you go about? If you go to the cash out refinancing route, you'll have to break your existing mortgage before you renovate. On a $1 million variable mortgage, your penalty is $4,250, like what we talked about before. Not bad, but there can be a better way. So let's see how a HELOC compares. The good thing about a HELOC is that there is no penalty involved. So even though HELOCs are around 1.5% higher than the current variable rate, you're actually only paying $750 more than a variable mortgage to borrow $100,000 for half a year. $750 is a lot less than $4,000, so getting a HELOC for a short-term loan like renovations actually make a lot of sense. The second scenario where a HELOC might make sense is if you're looking for stronger cash flows. Here's another thing. With a HELOC, instead of paying back a bit of your loan principal and interest each month, you only have to pay for your interest. So if you're deciding between two investments, A has 5% in annual appreciation and 3% in cap rates, and B has 2% in annual appreciation and 4% in cap rates. From a total return standpoint, A has better total returns, but you might not be comfortable with the cash flow situation since you'll be running negative after your monthly mortgage payments. Now, if you got a HELOC for A, then you end up being cash flow positive, which then gives you better holding power. And because A has better total returns, you end up still better after factoring in a higher HELOC rate. So just to wrap up on HELOCs, a regular mortgage in the long run usually makes more sense because the rates are lower, but it's also deal dependent. As you saw from our examples, there can be instances where HELOCs can work out better. The last refinancing method that I wanted to discuss is called a blended mortgage, and I'd say that this is probably the option that's great for all other scenarios. It's exactly what it sounds like. You blend your old mortgage with a new one, so you end up getting a rate that's somewhere in the middle. The best thing about a blended mortgage is that there's no penalty to access more equity, so this can be a huge benefit if you're currently on a fixed rate mortgage. Because you're blending your current rate with either a better rate or a worse rate, your new blended rate can either be better or worse than your existing rate, but will never be the best rate on the market. So if I were to summarize it, blended mortgages aren't the cheapest mortgages, but it can maximize the equity that you can pull out because it's not reduced by a penalty. More to invest means better absolute returns and a better selection of investments, so you might end up being better off than going with a cash out refinancing method and simply choosing the best rates out there. Blended mortgages actually come with a couple of variations. You can do a blend to term where you increase your loan amount, but you keep your loan term the same. Take a look at this example I found on ratehub.ca. If you have an existing 4.5% interest rate and you borrow more money at 2.99%, then you might end up getting a new blended rate somewhere in between at 4.09%. You can also do a blend and extend. In this case, besides increasing your loan amount, you also extend your term. This works well when you have a higher fixed rate and then interest rates drop drastically, since you'll end up putting a lot more weight on the lower interest rate, which can drastically lower your blended rates. If you're looking to refinance your home and buy another investment property in Toronto, but you don't know how to go about, let's chat. We're a real estate sales brokerage, so we can help you buy real estate, but we're also so much more because we focus specifically on real estate investments in Toronto. If you need the help, we can review your current situation, help you figure out how to optimize your portfolio, direct you to the right mortgage rep, and then eventually help you buy that best investment property that fits your needs. We're an end-to-end brokerage, which means our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.